Welcome to the second video on partnerships. You'll recall from the first video that we spoke about the formation of partnerships and also did some journal entries around formation and partners' contributions. We pick up where we left off and we'll go into example 2 now. So J. Stevens and E. Foster agreed to form a partnership. Stevens contributes land, inventory, and 24,000 cash. The land at a book value, that means the amount that it was recorded at in the books or in the accounts, of 65,000 and a market value of 114,000. You may recall that in your notes and in the textbook it says when partners contribute to the partnership, we record those contributions at their fair market value for the assets. The inventory had a book value of 60,000 and a market value of 56,000. So here again, the inventory is being compared book value to market value, just like we did with the land, and we see that there's a difference. The rule applies still that assets are recorded at their fair market value or market value. The partnership also assumed a $50,000 note payable owed by Stevens. This is interesting. We haven't seen this before. Basically, Stevens brings in a liability into the partnership. So the liability or the note payable may relate to the land, or it could be for something else, but the partnership has to now assume this liability, which means it's going to record the liability in its books. And since we're the accountants of the partnership, we'll be doing that. In the instructions, we are asked to prepare the journal entries for Stevens' investment in the partnership only. And the reasoning behind this is that Stevens has this liability that he or she contributes, and so this is something different, and we want to make sure that you know how to deal with that. So let's go into our journal page. So we'll start with the easiest, which is the cash, right? Cash has a fair value the same as the amount that's listed there. 24,000 is what's listed on the question. And then let's look at the land. So the land had a book value of 65,000 and a market value of 114,000. So you know that land is going to be recorded at 114,000. And again, the reason for that is that the partners agree that this land is worth more than what it was bought at. Maybe some years back it was bought at 65,000, but the land value has appreciated over time. By contrast, the inventory actually has a market value that's lower than its book value. This could be because it's some type of inventory that is not as popular anymore. So we record the inventory not at 60,000 but at 56,000, the amount at which the partners agree they would be able to sell it in the future. So those are all the assets. Now we also have to consider the fact that Stevens brings in a note payable liability. So a liability increases on the credit side, and since we want to record this liability on behalf of the partnership, we are going to credit note payable. This then means that the partnership now has this liability on its books. And now the final step is to record Stevens' capital. And the way we derive that amount is that we are going to add these three items together because those are the assets, and then subtract the liability, and the difference is going to be Stevens' capital of 144,000. And here we will just give a very basic description saying that Stevens invested. At this time, we will move now from forming a partnership to the next segment of our work on partnerships, which is about income allocation. Now, you may recall when we spoke in the first video, I was saying that if you start a partnership with someone, you end up possibly making profit or loss. There will come a time when you have to discuss how that profit or loss is shared. So you may be thinking, well, won't it just be 50-50? And the answer is not necessarily. Sometimes one partner is more active in the business than the other, or sometimes one partner is completely inactive and the other partner is responsible for day-to-day operations. And we may have more than two people, 3 or 4. So the question becomes, how do we allocate that? Well, the partnership agreement normally states how income and losses are allocated. And so what we'll be going through in this next section here is to look at examples of how income is allocated and also to see how we make closing journal entries for the partnership. If you refer back to your handout, you'll see that there are many ways in which income can be allocated in a partnership. It's possible that the partners could use a fixed ratio, like in this first question here, they use 60%, 40%, or they could just do 50-50, like in this question over here. They may also decide to do something like allocating salaries to some of the partners and then splitting the remainder. You can see in this question the remainder is split 50% to partner number 1, 30% to partner 2, and 20% to partner 3. And in addition to salaries, the partners may also receive interest on their capital balances. The reason for this is that the partnership is compensating the partners for the fact that they have made these investments into the business. So what's important with this income allocation is that we have to remember that we need to follow the instructions that we are given, and those instructions are likely coming from the partnership agreement. So we can't just arbitrarily allocate amounts. We have to check to see if we are actually following the partnership agreement appropriately. So in example number 4, Held Bond Company, which is the partnership, reports net income of $70,000. The income ratios are as follows, meaning this is what each partner gets. Partner held gets 60% and partner bond gets 40%. And the question says indicate the division of net income to each partner and prepare the entry to distribute the net income. So how would you go about this? Well, it's fairly simple, right? You are going to take the $70,000 and then just distribute it between these partners. One gets 60% and one gets 40%. So if we go into a new sheet, let me just make it a little bit bigger for you. So Held Bond Company, they have income of 70,000. Held needs to get, if we go back to the question, 60%, and bond needs to get 40%. So we just simply say 70,000 multiplied by 60% and 70,000 multiplied by 40%. So those two numbers together are obviously going to add back to the original 70,000 that we started with. Now the next question is, well, what is this journal entry that is being spoken of, right? It says prepare the entry to distribute the net income. Well, what we need to do, and you may think back to accounting 1 when we did closing journal entries. Basically, it's not enough to just do a calculation and say, oh, Held, you get 42 and bond, you get 28. We actually have to allocate these amounts to the partner's capital accounts. As such, we are going to prepare a journal entry. So just quickly making columns for debit and credit, and now this is where you have to cast your mind back to accounting 1 and remember an account called income summary, the account that would summarize net income or net loss, in other words revenue minus expenses. So in that income summary account we would have had the 70,000, right? And these partners now have to get the 70,000 into their partner's capital account. Now the capital account increases on the credit side and decreases on the debit side. Since this is income will increase. Income will increase the partner's capital account. As such, when we make the journal entry, we are going to debit income summary for the amount of the income, and we will credit Held's capital with 42,000 and then credit bond's capital with 28,000, and this is going to be a closing journal entry, and what we are doing is distributing net income to the partners. So in the end, instead of just doing a calculation, we are actually allocating those amounts. If the partnership had to end tomorrow, held would be owed income of 42,000 and bond income of 28,000. So this is a simple example of how to allocate income between two partners and how to make a journal entry. In the next video, we'll do a slightly more complex example which will also include drawings.